Hey everyone, it's Justin here, America's Honest Tax Accountant from Number Crunch Nerds. So the question for today is, are you ready to complete your 2025 Roth IRA conversion? Well, let's go through our Roth IRA conversion checklist for the year and see if we can figure it out. Remember, you have until December the 31st to complete a Roth IRA conversion. There is no extra time until April the 15th of next year. The extra time through April 15th is only for contributions to IRAs. It is not for conversions. Also, remember to bookmark this video, as it has been designed to provide you with the roadmap that you will need to get your Roth conversions calculated and figured out and done for this conversion season as quickly and easily as possible. So without further ado, let's jump into the Number Crunch Nerds 17-point Roth IRA conversion checklist. All right, item number 1, has your 2024 as filed Form 1040 information been appropriately entered into the personal tax planning template? So we're over here in the main tab of the personal tax planning template, and this is where I always recommend people start once they log in and download the personal tax planning template for the first time. What I want you to do is fill out this column for 2024, make it agree to your as filed 2024 tax return. For the moment, while you are working on this step, just ignore 2025 and beyond. I like to break it down for you one piece at a time so it doesn't seem overwhelming and you can get it done step by step. Now, as you go through the process of entering your information off of your 2024 tax return, the numbers that I want you to use as the primary double checks against your tax return start right here with AGI, adjusted gross income, and then right down here on this line, total taxable income. And then finally, right down here on this line, total tax, this number that appears right here should agree to line 24 right here, your total tax on your 1040 tax return for 2024. This is on page 2 right here of the return. Now, if during the process of filling out your 2024 column, you are running into some snags and you cannot get your total tax right here to agree to your 2024 tax return, the first thing I want you to do is go into the members area and find this section of the course, the member Q&A and template FAQs, and I want you to go down here and watch this video. It says if you can't get your 2024 column to match your tax return, this is commonly why. This video right here will go into the details of ordinary dividends versus qualified dividends, and as I just said, the treatment of these two items between your tax return and the personal tax planning template is the most common reason why people can't get them to match initially. Once you make the adjustments that are outlined in this video, you should have both matching perfectly down to the dollar. Okay, now after watching that video on ordinary versus qualified dividends, if you still are unable to get this number to agree to line 24 on your tax return, then you are welcome to reach out to me and I will help you figure out where the discrepancy is so we can get this number right here tied out down to the dollar. Every member of the personal tax planning template program, if you are struggling with the 2024 column getting this tied out, I will help you personally resolve that issue. And the reason we want this tied out down to the dollar is because 2024 is going to be our starting point for projections into the future, and it's those projections that will ultimately determine, number 1, where we have room in the brackets in the earlier years, and number 2, how high we are getting bumped up in the brackets in later years due to RMDs, also how high we're getting bumped up in the IRMAA brackets. And so we want to start things off right. We want this tied out down to the dollar and agreed to your 2024 tax return. Okay, item number 2 2 on the checklist, have you updated your 2025 taxable income projection based on the first 3 quarters of activity for the year? So going back into the personal tax planning template, once you get 2024 squared away, I want you to start working on 2025. Now, as of the making of this video, the first 3 quarters of 2025 are complete and there is 1 quarter left. So let me ask you a question. How easy should it be to project these numbers for 2025 now that 3 quarters are complete? Well, the answer is for most of these items, it should be relatively straightforward. For example, think about W-2 wages. If you are still employed and you have been paid for 3 quarters of the year, this type of income here is generally relatively consistent. In other words, you get paid every 2 weeks. It's usually the same amount. I can understand that if you change jobs or you get a raise or you go to part-time, sure, there could be some difference in what you might be making in the final quarter versus the other 3 quarters. But generally speaking, you should be able to project this number for the full year with reasonable accuracy. Just as a simple example, if you made $25,000 per quarter for the first 3 quarters, that's $75,000. What number would you expect to have right here for the full year of 2025? And the answer would be $100,000, right? Because you're going to earn probably another $25,000 for Q4, assuming that your job is stable and the pay is the same. Same concept down here with interest income. Interest income is generally a relatively stable cash flow stream. It's paid on a certain repetitive basis, like monthly or quarterly or something like that. If your investments have not changed significantly between the first 3 quarters of the year and Q4, then I would expect that whatever interest you may have earned in each of the other 3 quarters is probably roughly what you're going to earn in Q4. Therefore, you should be able to estimate this number for the full year 2025 with reasonable accuracy. Same concept when it comes to dividends. If you have dividend paying investments and those investments are relatively stable, then I would expect that your dividend projection for the full year would basically be an annualized amount based on the first 3 quarters. Just as an example, if you earned $1,000 of dividends in Q1 and $1,000 in Q2 and $1,000 in Q3, then what are you probably going to earn for Q4? $1,000. And therefore, I would expect $4,000 to be shown right here. Also remember, for purposes of the personal tax planning template, we are putting non-qualified dividends on this line right here, and we are putting qualified dividends down here on this line. If you are unclear on the difference or why it is set up like that, remember the video that I just told you to watch a few moments ago. That video is what will clear up that issue for you. Now, with respect to short-term capital gain, this could be one that is a little bit more difficult to project with several months left in the year. You may not know exactly at the moment how much short-term capital gain you're going to harvest, but one of the main items, which we will talk about in a few minutes regarding filling out the personal tax planning template, is to figure out how much capital gain or loss you're going to harvest during the year. And therefore, even though you may not have a perfect number to put in here right now, as we go through the rest of the process, you will be able to hone in on how much potentially should go here. Now, on the flip side of that, if you have capital loss carry forward, you are aware that you can deduct up to $3,000 per year against ordinary income, and therefore this number would be known at this point. If you have no capital gain to offset it, you'll just be deducting $3,000, kind of like it's shown right here. And so in that situation, this number would be very easy to project because it's only going to be $3,000, assuming you have carry forward. Now, skipping down to this section, if you have started pensions or you have started Social Security, both of those items are generally relatively stable, and therefore it should be easy to project what the full year's amount is going to be. And after you do that, I want you to put the full year's projection of those amounts in these rows right here. For the couple that you're seeing in this example, we don't actually have pension and Social Security income starting until out here in these years, but right now we're just working on 2025. So if you are pre-pension occupation pre-Social Security, then these two would just be blank for the moment. Now, with respect to Roth IRA conversions, this is one of the items that we are working toward figuring out as part of laying out our numbers in the personal tax planning template. And so on your first pass for 2025, you might leave this one blank for the moment, and then we'll come back later and fill this out once we have projected the rest of our income out into the future and determined what our RMDs are going to be. So let's just repeat again, on your first pass for 2025, you might leave this item blank, and then we'll come back and fill this one out a little bit later. Now in this section down here on the long-term capital gain income, long-term capital gain, similar to short-term capital gain, may be more difficult to project because you haven't fully determined yet how much you're going to harvest for the year. However, I expect that your financial advisor is probably going to be asking you, if they have not asked you already, how much capital gain do you want to harvest or capital loss for the year as part of your tax strategy. Since your financial advisor is most likely not handling your tax strategy, I would not expect them to just know off the top of their head how much capital gain or loss you want to harvest for the year, but I would expect that they ask you how much you want to harvest, and in order for you to figure that out, that's part of what we're doing right here in the personal tax planning template. By the way, if your financial advisor does not ask you how much capital gain or loss you want to harvest for the year, well, not all financial advisors are created equal, is what I would say to that. So that's a decision about your financial advisor that I would leave to you, but I would be prepared to answer that question, and the way to get prepared is to fill out your numbers in the personal tax planning template and see how much room you have to harvest those capital gain and loss items based on all your other income, as well as any capital loss carryforwards that you may have, which we'll talk about in a few minutes. Actually, that will be the next item, number 3 here. Have you determined how much capital gain or capital loss, if any, you are planning to harvest before the end of the year? Recall that right here on this tab, we now have the capital gain full calculation built into the personal tax planning template. And so this calculator will determine for you how much of your capital gain is being taxed in the 0% long-term capital gain bracket, how much is being taxed in the 15% long-term capital gain bracket, and then how much is being taxed in the 20% long-term capital gain bracket. And you will generally use that information to make sure that if you are in the 0% bracket for capital gain, you may want to hold off on Roth conversion for that particular year, as it will cause your capital gain to be bumped up from the 0% into the 15% bracket. And then conceptually similar to that, if you are high up in the 15% long-term capital gain bracket, it is possible that additional income could bump some or all of that long-term capital gain into the 20% long-term capital gain bracket. And so this calculator right here will provide you the insights that you need to determine where you are exactly within the special long-term capital gain brackets. Now, coming back over here on a related note, have you appropriately filled out your capital loss carryforward schedule, if applicable, so you know how much is available for 2025 and going forward? In order to find the capital loss carryforward schedule inside the members area, go right here to this section of the course, What's New, the latest updates. Go right over here to the update for June the 21st, 2025. And right here is where you will download the 2025 capital loss carryforward schedule. And there is also an update video going over how to use the capital loss carryforward schedule. And this is what the capital loss carryforward schedule is going to look like. We do have the short-term capital gains and losses over here. We have the long-term capital gains and losses separated out over here. And as you walk through the instructions on how to fill out this schedule, you will be able to determine how much capital loss carryforward you have, how much can be used to offset capital gain that you may be harvesting or generating in the current year as well as future years. And then, of course, if you have more capital loss than capital gain in one category or the other, meaning short-term or long-term, the schedule will shift the long-term capital loss from one side to the other, or vice versa, just depending on how your numbers play out. All of that is explained in the instructions below. And so this is definitely something you want to have filled out and prepared appropriately only if you have capital loss carryforwards. Okay, item number 4, if you are still employed, have you projected W-2 wages out to the year when you're estimating that you may retire? I'm going to also throw in item 5 here. Have you considered changes to your interest and dividend income based on your employment versus retirement status and changes in your portfolio weightings and strategies as you get older? And as a possible example of that, have you considered decreases in your interest and dividend income going forward if you are planning to use money from your interest and dividend generating assets for purposes of living expenses as you move into retirement? So back here in the personal tax planning template, right now we have done our first pass of 2025, but in order to make the 2025 column complete, in other words, in order to fill out this line, the Roth IRA conversion line, and also possibly these lines right here regarding how much long-term or short-term capital gain or loss we're going to harvest, we need to move forward into the future and project what our taxable income is going to look like out here. That way we can figure out how much of that income we want to shift back into 2025, for example, through a Roth IRA conversion. That decision will also have an impact on how much capital gain or loss we want to harvest. So right now, after you've completed your first pass on 2025, let's start projecting income out into the future. Now, with respect to W-2 wages, for example, I said, have you projected income out to the point where you were considering retiring? So if we look at this example that just happens to be populated here, we can see that for spouse 1, they are projecting to work until they are age 64, and then they are planning to retire with no additional W-2 income for age 65 and beyond. Now, as the personal tax planning template is set up by default, both spouses are the same age, but obviously you would adjust these to reflect whatever your age happens to be in those particular years. Now, with respect to spouse 1, what could something like this right here be interpreted to mean? Well, it could mean that in 2024, for example, let's say that spouse 1 was on sabbatical for most of the year. Or let's say they were working on some other venture like their own business and they weren't actually employed as a W-2 employee for most of 2024. Let's just say they started their position at the end of 2024, and that's why we see a much lower number right here relative to the subsequent years. In these years right here, spouse number 1 is working on a full-time basis, and then spouse number 1 is going to retire right here. Now for spouse 2, let's just go ahead and change these to be 90,000, for example. Let's say it's 90,000. It's growing a little bit for cost of living by $2,000 over these years right here. Let's say spouse 2 was on leave for some reason, or they were on sabbatical, or they were otherwise just not working in 2024, or maybe they were helping spouse 1 with the family business and they did not work at all during 2024, and that's why this number would be blank. Then they went back to work in 2025, they worked for 4 years, and then let's say they only worked for half the year, or they expect to only work for half the year in 2029 when they are 65. And so that would be a fact pattern that would play out something like this. You would see the salary cut in half if spouse 2 was only planning to work half the year. Now, what about interest income? Let's say that the investments that this family hold are heavily interest bearing, but once they reach retirement, they decide with their financial advisor that they're going to have a big shift in the way that their portfolio is structured. Perhaps they're going to change these investments over to tax-exempt interest as a possibility. Maybe they're going to switch these investments over to types of investments that pay dividend rather than interest. And so even though during the employment years they see a higher number right here, when we go out here into the retirement years, they're expecting a substantially lower amount for whatever the reason is, for whatever the facts and circumstances of the situation may be. With these accounts right here, which also relate to interest-bearing accounts, let's say that they're not expecting much change between employment and retirement, and so that is just consistent going out into the future. Now, one of the questions I posed just a few minutes ago is, what if you are planning to use use some of your interest-bearing investments for purposes of living expenses? Well, in that case, I would expect to see perhaps something more like this. Let's say that instead of changing these investments over to like tax-free interest income, for example, this couple decides with their financial advisor to leave the investments as are, except for the fact that every year they're going to be distributing money to themselves. These are from fully taxable accounts, but they're going to be using that money as part of their retirement strategy. And so therefore, I would expect to see the interest income decreasing, but perhaps not in such a dramatic way. For example, if we change up some of these numbers here, let's say that the couple was planning to use up assets in an amount such that interest income was expected to decrease by, let's just say, $10,000 a year. In other words, enough of the asset was used up such that the total interest income for the year decreased by $10,000, and that was kind of expected to be the case going forward. And so each year they would see a decrease until they got out here where perhaps they stop using those assets. Perhaps out here they start using other sources of income like RMD income out of their traditional IRAs right around here, the time of age 73. And so therefore they would stop using up these taxable assets, and therefore the interest income would kind of level off at around this amount into perpetuity. Take note that I'm not saying it has to be one way or the other. That is just an example of how you might interpret these numbers and how you might look at this schedule when you're setting it up for yourself based on your facts and circumstances. All right, going back to the checklist, item number 6, if you haven't yet started Social Security, have you entered the projected benefit for both spouses for the year when you are planning to begin collecting? And conversely, if you have started Social Security or are projecting to start it in some particular future year, have you projected it going forward to include a reasonable annual cost of living increase? Okay, back over here on the personal tax planning template, here are the two lines for Social Security, one for each spouse. You can see right here that based on the way the personal tax planning template is prepared, spouse number 1 is projecting to start Social Security at the age of 67. Spouse number 2, on the other hand, is planning to push out Social Security to the age of 69. Now, as many of you have seen in the multitude of discussions that we have had on the channel regarding Roth IRA conversions, the decision regarding when to start collecting Social Security can be influenced by the Roth conversion decision. For example, the longer you push out the start date of Social Security, not only will you get a larger annual benefit, but you will free up room over here for greater Roth conversions. Alternatively, if you start collecting earlier, you will ultimately receive a lower annual benefit for the remainder of your life. But in addition to that, you will be filling up the brackets with Social Security income, which would reduce the amount of room that you potentially have to complete a Roth IRA conversion. So these Social Security numbers, particularly if you haven't started collecting yet, or perhaps if one spouse has started but the other spouse has not started collecting, these are numbers that you can play around with regarding the potential starting age. Remember, you can choose to start Social Security anywhere between the age of 62 and 70. And so that's another factor you want to consider as you're laying out your numbers, so that way you can maximize your potential Social Security benefit while also potentially creating room for more Roth conversion in earlier years, which of course has the added benefit of potentially lowering the IRMAA bracket that you end up in, because remember, IRMAA measurement, which we will talk more about in a little bit, that's going to start at age 63 because Medicare starts at age 65, and IRMAA brackets are measured based on your MAGI from 2 years prior, and that is the reason why we call these earlier years between 59 and a half and 62 the Roth IRA conversion super sweet spot, because the more income you can pack into these years, the more income you will potentially get out of your IRMAA determination. So you can see from that there are a lot of moving parts that all need to be fit together, and the way to do that is to lay out all your numbers into the future and find that room in the brackets in earlier years and figure out where you're getting bumped up in the later years. And that is the process by which you will land ultimately on the amount of Roth IRA conversion that you want to do on an annual basis. By the way, while I was recording this video, I got an email from one of the members of the personal tax planning template, and it's a really long email, but I just want to bring your attention to these comments right down here because they're in line with what I was just saying about so many different moving parts that you have to fit together. It says the PTPT is an amazing file. It is just what I was looking for when I found it online. I was trying to build a similar file, but it got so big and cumbersome that I kind of gave up. I really like how you tied things together, and it has energized me to get back into establishing a strategy. This right here is one of the main reasons why most Americans don't do any tax planning. And what's the reason? Because there are so many moving parts that it's hard to put it all together. You need a tool where you can actually lay out all your numbers into the future and figure out what your tax plan is, not just in words, not just by thinking about it, but by the numbers, by really looking at how your numbers play out and how your facts and circumstances change over time. Doing tax planning without a tool that actually allows you to do it is kind of like saying, I'm going to repair this car, but I'm not going to have any wrenches available to do it. You follow what I'm saying? Without the right tools, it's really hard to get the job done. And when it comes to personal tax planning, my personal tax planning template has everything that you need to lay out your numbers and figure it out. And so this person concluded with thank you for this tool. Okay, back to the checklist. Item number 7, have you determined if you will be itemizing deductions for 2025 through 2029 due to the SALT cap being increased to $40,000 up from $10,000 during that 5-year time period? If we go back into the personal tax planning template, this is the itemized deductions section right here. We also have the up to $40,000 state and local tax deduction calculator right over here. This will help you determine if you're going to get the full $40,000 or if there's going to be some sort of limitation for you based on income. Take note that the SALT cap previously being limited to only $10,000 under Tax Cuts and Jobs Act is one of the reasons why many people stopped itemizing back in around 2017, 2018. And so if you used to itemize back then, it is possible you will be itemizing again based on this new limitation, even though perhaps you have been taking the standard deduction for the last 8 years or so. So this section of the template is something you may need to give attention to starting in 2025, even though in the prior few years you haven't itemized. By the way, the increase in the SALT cap limitation up to $40,000 could heavily influence your decision to increase and accelerate Roth IRA conversions, since you can offset that income with the SALT deduction for the 5 years between 2025 and 2029. In addition to that, if the SALT cap allows you to itemize, then you want to start gathering up other items which maybe previously you were kind of neglecting. One could be medical expenses. You can deduct those. One could be charitable contributions. These are separate from QCDs, which we will talk about a little bit later. And then, of course, home mortgage interest is going to be the other big item on Schedule A, which is the itemized deduction schedule. If you want more information on that, there is a SALT cap members update video right here. That is in the July 26th, 2025 update, which can be found in this section of the personal tax planning template members area, right here under the What's New Latest Updates. Okay, item number 8, have you determined if you will be eligible for the additional $6,000 senior deduction that is available between 2025 and 2028? We do have the up to $6,000 senior deduction calculator built into the personal tax planning template. This calculator will help you determine the deduction phase out as well as the maximum deduction deduction that you are ultimately allowed on your return. You can find a members area video on that also in the What's New Latest Update section of the course. Right here it's the July 11th, 2025 update, and you're looking for this video right here related to the $6,000 senior deduction. Okay, item number 9, have you determined if you are considering purchasing a new personal use vehicle, i.e. not a business use vehicle, and therefore may be eligible for the up to $10,000 auto loan interest deduction between 2025 and 2028. Back on the personal tax planning template, we do have the $10,000 auto loan interest deduction calculator right here. And note that all of the OBA modifications, these are the laws that were put into place on July the 4th, 2025 with the One Big Beautiful Bill Act signed into law. That includes the auto loan interest deduction, the above the line charitable deduction, which actually does not start until 2026, so that's a planning item only for 2025, as well as no tax on tips and no tax on overtime, for which there are calculators in the personal tax planning template if that is applicable to you. All of those items will be on the main tab right here in this OBA modifications section. For more information on that one, go to the members area What's New Latest Updates section, and you're looking for the July 10th, 2025 update. Right here, the $10,000 auto loan update training video. Okay, item number 10, have you updated your 2025 IRA ending balance projection to reflect portfolio changes that occurred in the first 3 quarters of the year? Okay, so now back on the personal tax planning template, we are now talking about the Roth conversion tax strategy tab. This is where you're going to be projecting the balance of all of your traditional IRAs, and of course this is by spouse. Everything related to IRAs, whether traditional, Roth, or otherwise, is all tracked on a per spouse basis. You're going to project the value of that into the future. Now right here at the end of 2024, this number is known. You have already updated that, or if you're new to the personal tax planning template, that's one of the first things you will update, because of course we need a good starting point, and that's going to be 12/31 of the prior year. All of that is covered in the basic training videos for new individuals when you join the program. But now let's think about 2025. Right now we have a projection in here, and if you haven't made any changes to this tab since earlier in 2025, you may be sitting here with a percentage growth rate for the year which does not actually reflect what you've been truly receiving in your IRA portfolio during the year. So what you want to do is gather up all of your balances as of the most recent brokerage statement, and based on those you want to kind of gauge where you think your estimate for 2025 is going to land as of the end of the year. Obviously, I know that you can't predict the stock market. You can't know exactly what it's going to be. It's going to be an estimate, but you want to try to make it as reasonable of an estimate as you can. And if 5%, for example, is way off based on what your IRA portfolio has actually returned, now would be a good time to update that to reflect something that is more in line with what you are actually receiving. And of course, the reason we want to do that is we want to try to gauge what a realistic ending balance is going to be for 2025, because ultimately RMDs, or our projected RMDs if you have not reached RMD age yet, those right here are going to be based off the ending balance of our traditional IRAs for the prior year. So the more accuracy that you can start to get into your ending balances, the more accuracy you will get in your projections of your RMDs. And of course, the more accuracy we can get in our projections of RMDs, the more accuracy we can get in our projection of overall taxable income as we go into the retirement years, and thus we can get more accuracy in the amount that we want to convert into the earlier years in order to reduce this RMD income. Okay, item number 11. Have you considered the level to which you will make QCDs in 2025 or going forward? Note that the max QCD for 2025 is $108,000, and remember that's a per person amount. Also remember that QCDs are now indexed for inflation. So if we go back over to the personal tax planning template, we're still working in the Roth conversion tax strategy tab. Here's the QCD column right here. Now there's two ways that a QCD can reduce your RMD. And more specifically, I should say reduce your taxable RMD, not necessarily the total RMD that comes out of the IRA each year. So the first way that a QCD can reduce your RMDs, we'll call that the indirect way. And that would apply between the ages of 70 and a half, which is how old you have to be to make a QCD in the first place, and then up to age 73 right now, or up to age 75 after 2033 when the RMD age increases to 75. During that time period, you can give a QCD to a qualifying charity of your choice, and the way it reduces RMDs going forward, not necessarily in the year you give it, but going forward, is that it simply reduces the balance in your traditional IRA, and therefore future RMDs would be calculated to be lower because your IRA balance is lower. The second way that a QCD can reduce your taxable RMD, we'll call that the direct way. And what that means is that a QCD counts for purposes of your RMD requirement each year. Note right now that I'm just using $105,000 in each of these years as an example. But recall that I said for 2025 the maximum amount is actually $108,000, and that will increase annually due to inflation adjustments. But just focusing on the concept, I have put QCDs in right here. Also note, you don't have to give the maximum. You can do a QCD of any amount. So going back to the direct way in which a QCD can reduce your taxable RMD, right here in this column, this is where your RMD is initially calculated before any other adjustments are made. And the number right here for the RMD is simply the ending balance of the IRAs from the prior year divided by the relevant RMD factor. For those of you who've been following the course for a while, you know that these factors come out of IRS publication 590B, but we have those populated here in the personal tax planning template, so there's no need to have to look those up each year. And that calculation will produce your RMD before any adjustments, in this case $169,891. But right here, let's just say that we do a $105,000 QCD in this particular year. In that situation, this is still the total balance that comes out of the IRA for that particular year, but $105,000 of it goes to the qualifying charity and therefore is not taxable income, and only $64,891 would become your taxable RMD. Now, for those of you new to the personal tax planning template, the way that this would work is this $64,891, which in this particular case relates to the year 2039. If we go back up here to the main tab of the personal tax planning template and we go to the RMD line right here for spouse number 1, there's the $64,891 carrying up here from the Roth conversion tax strategy tab. That is for the year 2039, as we just stated, and that's how we determine how much of the RMD is taxable and ultimately ends up in this column in the taxable income calculation for this year. Okay, item number 12. Have you calculated what your RMD will be per spouse for the current year? Remember that since this year's RMD is based on last year's total traditional IRA balance, this calculation is no longer a projection. You can calculate your actual RMD for the year. So going back over to the Roth conversion tax strategy tab, right now we have this individual reaching the age of 61 at the end of of 2025, so they are not yet in RMD territory. But let's go ahead and change that so we can see what it would look like to calculate your actual RMD for the year. So right here, enter the age on 12/31/2024. I'm just going to go ahead and say this person was 72 years old instead of 60. And then I'm going to change the birth year right here. That would mean that they were born around 1952. We're going to go ahead and toggle this calculator right over here to pre. That will cause the RMD to start calculating at the age of 73. If it's toggled to alt, it will start calculating at the age of 75. But remember, that's only applicable if you have not reached the age of 73 by 2033. So looking back over here now at 2025, you can see they are going to reach age 73 during this year, and therefore the RMD calculation, which is based on the ending balance of the IRAs in the prior year right up here, again divided by the relevant RMD factor for your age, will give you the RMD calculation for 2025. So again, the main point of that exercise was to demonstrate that this RMD right here is an actual amount based on your finalized balances as of the end of the prior year. Everything beyond the current year will be a projection, and this is where you have opportunities to start looking for reductions to your RMD. One of those possibilities is a Roth conversion, particularly if you're under age 73 and still in the Roth IRA conversion sweet spot. Another opportunity is QCDs, which we were just talking about. That reduces all of these taxable RMD balances by $105,000 in this example. Back over here to the checklist, if you are not yet age 73, have you projected what your RMDs will be starting at age 73 and going forward, and included those amounts in your income projections within the personal tax planning template? So going back over here to the Roth conversion tax strategy tab, I have switched this back to the previous example. RMDs for this individual are now starting at age 2039. And the key to the question that was just asked, which is really one of the ultimate keys to figuring out the amount of Roth conversion you want to do, is that these taxable amounts of the RMD, we've already looked at the 64,891, but every one of these 70,000, 74,000, and then up into the 180s and the 190s, all of these, when I go back to the personal tax planning template and I start scrolling out to the right over here, you can see all of these RMD values populating in the taxable income columns for those relevant years. And it's these amounts that you want to look at in conjunction with all of your other income to see how high up in the brackets you are currently getting bumped. If all of your income items out here is bumping you up into, let's say, the 32% bracket, and you have a lot of room back here in the Roth conversion sweet spot, let's say in the 22 and 24% brackets, there's an 8 to 10% tax differential between getting taxed at 32% out here and getting taxed between 22 and 24% over here. And so first we identify all of the income that we're expecting out here, the majority of which for many people will be this RMD income. Then we identify how much room we have in the brackets over on this side in the earlier years, and then we start shifting that income from over here back over to this side in the form of a Roth conversion to smooth out the income over time. The more you can get out of the 32% bracket and into the 22 and 24% brackets over here, or looking at it another way, if you're in the 24% bracket over here, but you're actually in the 12% bracket over here and have a lot of room, you're shifting income to a 10% lower rate in that example. And when you sum up that tax savings at an 8 to 10% differential over time, it can add up to tens of thousands, even hundreds of thousands of dollars, just depending on the numbers that you're working with. Okay, back to the checklist. Have you appropriately considered if your RMDs will start at age 73 or 75? That will depend on your current age. Again, that is a per spouse question. And remember that the RMD starting age changes to 75 starting in 2033. We just talked about that a little bit a few minutes ago. The way we handle that inside of the Roth Conversion Tax Strategy tab is right up here. If this says Alt, it will start the RMDs when you turn age 75, like it is doing right there. If we toggle that to pre right here and your age and birth date are appropriate to start RMDs at age 73, then you will see the calculation of the first RMD will start at age 73. So that is how you take it into account. Fill out your age and birth year appropriately right here, and it will determine whether the RMDs should start at 73 or 75. That is what the question was referring to. Okay, item number 13. This is one of the biggies. Have you analyzed IRMAA impact, including IRMAA widow's penalty on any decision to skip or minimize the amount of Roth IRA conversion that you are considering for the year? Recall this video right here from several weeks ago where we went over IRMAA impact as well as the IRMAA widow's penalty. This is where people get hammered, and usually they never realize it until it is too late. Going back to the personal tax planning template, we are now talking about the IRMAA calculator tab right here. Now keep in mind that the IRMAA bracket that you ultimately fall into for any particular year is going to be heavily influenced by your AGI. And AGI, of course, comes from the main tab of the personal tax planning template, where we are calculating your taxable income and ultimately your projected tax for all years going forward. Just as an example, let's just pick a year at random. How about 2032? So for the Medicare premium year 2032, your IRMAA bracket is going to be based on your MAGI, which is basically just AGI with a few adjustments. There is a video inside the members area showing you how to calculate MAGI if you have any questions about that. But generally speaking, it's going to be based on your AGI from 2 years prior. So in this case, 2030. In other words, if I go right down here, this is my AGI that my IRMAA brackets for 2032 are being based on, but the number itself comes from my taxable income calculation from 2 years prior, in other words, 2030. So now if we go over to the main tab of the personal tax planning template and we look in the year 2030, I would expect to see AGI of 310,185. Okay, so we're right back over here on the main tab. I'm going to go to the year 2030 and then I'm going to scroll down to find AGI, and there it is, 310,185. As we discussed in this video right here, one of the biggest hidden traps out there is IRMAA widow's penalty. You have to start planning for the possibility of one spouse ending up in the single brackets, and the more RMD income that you have because you haven't completed sufficient Roth IRA conversion, not only will that bump you up into the higher income tax brackets, but it will bump you up into the higher IRMAA brackets based on a single filer, which has the ability, as we saw in this video, to increase your monthly IRMAA premium from like $76 up to $400 or more. It's a really big issue that most people forget about completely, and by the time they arrive where one spouse is the surviving spouse and they're subject to those IRMAA brackets, those single filer IRMAA brackets, they get hammered with those IRMAA premiums, and it's too late to do anything. If you want to do something about it, the time is now while you are in the Roth IRA conversion sweet spot. So if you haven't watched this video, which is on YouTube, I highly recommend you go check it out so you can have a full understanding of that issue. Which, by the way, brings us to item 14. Have you started planning for single tax brackets starting at the end of your projections and working backward to minimize minimize the impact of widow's penalty on your family's lifetime income tax burden as well as IRMAA widow's penalty. Now, the key to this right here is very simple. I understand you cannot predict with precision how long you're going to live. That would be an exercise in futility. I'm not going to say, why don't you just guess how long you're going to live? That is not the point of this exercise. Instead, the point is to go down here to this section of the tax calculation where we make the choice between filing married and eventually filing in the single brackets. What I would do is start by toggling all of these to married, going all the way out to the end of the spreadsheet. In that case, it would look something like this. We have the married filer toggle switch on all the way to 2054, which is currently the end of the spreadsheet, but there is a video inside the members area that will show you how to extend this beyond 2054 if you're younger right now and you need more time for your planning. So back down here, I would start with all of these toggled to married. And then what I would do is start with, let's say, a 5-year period where we're going to toggle all of these to single, just like that. And then we're going to look at the results of our tax calculation and our IRMAA calculations and see what the impact is, assuming that one spouse was to pass 5 years before the other. Then based on that 5-year period of one spouse filing in the single brackets, you might determine, hey, I should do a little bit more Roth conversion, get some more income out of these years because it's going to be taxed at the single rates. See if we can push income back over here into the earlier part of the personal tax planning template when you're younger, when you're in the Roth conversion sweet spot, when you have more room in the brackets. And after you complete that exercise, I would continue by saying, okay, what if one spouse passes 10 years before the other? So now we have a grand total of 10 years in the single brackets, and then the rest of the time are going to be in the married filing joint brackets. And I would see what the overall outcome is on your RMDs, on your IRMAA planning, on your lifetime tax burden, all of which can be viewed on the different tabs within the personal tax planning template. And the point in this is an exercise in being fiscally conservative. To say that another way, without trying to determine, okay, one person is going to pass in this year or that year, which we've already established is an impossible task. There's no way to do that. Let's be conservative and say, how many years can we put in here in the single brackets? Because the single brackets are more conservative than the married filing joint brackets, meaning when one spouse passes and the IRA of the spouse that passed becomes the IRA of surviving spouse now has to deal with all the same amount of RMD income, RMDs from their own IRAs and now RMDs from their IRAs, which used to be the deceased spouse's IRAs, but they have to deal with them in the single brackets, which are lower. And therefore, when you're planning out what your total RMD income is going to be, and you can squeeze it into the single brackets and still keep yourself at a low enough marginal tax rate to meet your goals, that is being more conservative than planning for married filing joint brackets out here when the likelihood of one spouse passing before the other is a likely possibility, particularly if one spouse is already younger than the other by any substantial margin. And so that's how I would approach it. Start back here, throw in a few years of single, see what it does, throw in a few more, and see how far back you can go. And eventually, if you have enough of these identified as single and you've still met your overall tax planning goals, then I would call that a solid answer, a conservative answer, and it will allow you to plan for the inevitability of widow's penalty that will be coming your way at some point, both for tax purposes as well as for IRMAA purposes. Okay, item 14. This is actually what we just went over. Have you started planning for the single tax brackets starting at the end of your projections, like we just went over moments ago, and working backward to minimize the impact of widow's penalty on your family's lifetime income tax burden, as well as IRMAA planning? We already covered that one in detail, so we're going to move to item 15. Have you estimated the timing and amount of any possible inherited IRAs that may be coming your way and their impact on your future taxable income? So going back to the personal tax planning template, we do have tabs for inherited IRAs. If you're going to inherit more than one, you would just copy this tab and make one tab per inherited IRA. This right here is not generally talking about inheriting an IRA from your deceased spouse. This is inheriting an IRA from somebody else. Most of the time when you inherit an IRA from your deceased spouse, the IRA effectively becomes your own, and you would follow your own RMD rules as if the IRA belonged to you the whole time. You can choose to treat the inherited IRA from your spouse as an actual inherited IRA and follow the inherited IRA rules, but generally that's not going to be as favorable because most of the time it requires the RMDs to be taken faster. This right here is talking about inherited IRAs from a parent, for example, would be the most likely situation. And so you're going to have to take RMDs from that inherited IRA over a 10-year period and ultimately drain the balance of the account by the 10th year. A couple of items to take note of. One, similar to what we talked about regarding widow's penalty, you can't in most cases probably know exactly when a parent or somebody from whom you might inherit an IRA is going to pass. But on the other hand, in some cases you can. It could be that someone in that situation may not have that long to live, and so you can somehow estimate within the next couple of years, chances are you're going to be inheriting an IRA. Now, whether or not you know the balance in that IRA roughly is going to be based on your personal situation. Some families are very close. They know what the balance of the inherited IRA is probably going to be, more or less. Some families, it's going to be a big secret, so that's going to be kind of an individual situation. But assuming you can at least estimate what it is approximately, you put the balance of what you're expecting to inherit in here so that we can calculate what the RMDs are going to be on that over the relevant years. The second item to note is that because an inherited IRA needs to be drained by the 10th year, if you do not plan accordingly, the 10th year will become a balloon payment. And a balloon payment just means a big amount. The entire amount that is still left in there that you haven't taken over the previous 9 years, all of that is going to come out at once, and that could bump you up substantially into higher brackets for that year. So that is something you want to take account of in your overall planning for RMDs and Roth conversions. Okay, back to the checklist. Item number 16. Based on your Roth IRA conversion decision in Q4, your estimated tax payments that were made in Q1 through Q3, if any, and your withholding, if any, have you used the Safe Harbor method calculator to determine if you will need to make a Q4 estimated tax payment by January the 15th, 2026. We do have a complete training video on the Safe Harbor calculator as well as the calculator download itself. You can find those within the What's New Latest Updates section of the members area. If you're going to be doing Roth IRA conversions now or at any point in the future, you want to become familiar with the Safe Harbor estimated tax payments method, and this video right here will show you how to do it. On a similar note, item 17, have you considered whether electing the annualized income installment method would be beneficial for 2025 to help you reduce or eliminate any dings that you could be facing in the form of interest and penalties on the underpayment of taxes? The annualized income installment method calculator download as well as the line-by-line training video. Those are available in the 11/30/2024 update right here in the What's New Latest Updates section of the members area. The AIIM method is a very important method to be aware of and understand, and can save you at the last minute potentially hundreds, thousands, or even tens of thousands of dollars in interest and penalties, just depending on the size of the numbers that you're working with. And the beauty of the AIIM method is that you can make it at the last minute with the filing of your return, and depending depending on your facts and circumstances, depending on the situation, it could instantly save you thousands of dollars in interest and penalties. It's something very important to be aware of, so I recommend you take a look at this training when you have an opportunity. By the way, if you are not currently a member of the Personal Tax Planning Template program and would like to join, lifetime access to the program is available for a one-time access fee in the link in the description below this video on YouTube. My Personal Tax Planning Template program is arguably the most complete and comprehensive individual income tax planning training program on the market in the United States today. Take a look at some of these recent comments by members of the program. Justin, your videos are so detailed and understandable. Thank you for helping us primarily old school retirees. And over here, thanks again for all your hard work and excellent education material. It is helping me to no end figuring out our future retirement taxes, Roth conversion, and trying different distribution strategies. And right down here, Justin, your spreadsheet is amazing, as is all of the work you've put into the videos within the members area of the Personal Tax Planning Template. It's like having a financial advisor report whenever I want for whatever changes happen or that I want to model. And then finally, right over here, Justin, I wish I had paid more attention to the tax implications of retirement when I hit 60, and I have encouraged others to learn from my mistakes. I'm now turning 73 this year and am facing large RMDs. As I said, you can join the Personal Tax Planning Template program with lifetime access for a one-time access fee at the link in the description below this video. And that's going to be it for today's video. Thanks everybody for watching, and I'll see you next time.